Okay, so who are UPGS, or Ultimate Products, as we refer to ourselves on a day-to-day basis? Well, we put some information on the slides about who we are as a business. We're 20 years old, based up in Greater Manchester, there in Oldham, and we're a consumer goods business. So it's product for the home. Is probably the easiest way to explain it. We're very much mass market and value led. If you see us in John Lewis, give me a call, because we're probably doing something wrong. We want to be, as you'll see as we go forward, in the likes of the discounters and the supermarkets. Now, it's always very difficult to explain the company off a slide and in a room like this. So I've brought some product just to illustrate. I can't compete with cake. So I apologise in advance. That was a great move. This isn't one of our products, okay? So just to be clear, this isn't one of our products. And mugs are not a huge part of our business from a value point of view, but we do sell 1 million mugs a year. And this is an own label £1 mug. It's not ours, by the way. And if you believe that value is the perfect symmetry of spec and price, then you cannot argue with a £1 mug. The problem is, you wouldn't want to drink your tea out of it. This mug would make you feel quite sad, unfortunately. Just imagine, about 85% of our consumers are female, so you're not exactly our target demographic, apologies in advance. About 85% of our consumers are women, many of them are mums. So just imagine the working mum. She's come home, she's got, from work, she's got 10 minutes to have that precious cup of tea before the kids come in from school, and she's got to get the tea on. She doesn't want to drink it out of this mug, okay? We think she wants to drink it out of this mug here. Right, this is bone china, Portobello branded, beautifully designed by our in-house design department. With a butterfly theme, doing some nice details like the butterfly inside. This will retail for £2.99, so it's obviously significantly more expensive than this, but it's still at a mass market price. It's still in that affordable bracket where it's not too much of a considered decision. And you can actually fit a cup of tea inside this one. And this would make, we want our product to make people feel good about themselves, because we don't think value is about cheap stuff. It's about the way it makes our consumers feel. Another example, and again, this one isn't our product, and it's a very good product. This is an own label, non-stick frying pan. Okay, and it's 12 quid, which can't really argue with that. Again, if you believe that value is about spec versus price, that's a good product, and it is quite well executed. But we don't want the consumer to have that. We want the consumer to have this product. Right, this is the Salter Megastone frying pan, and we sell 1 million frying pans a year as well, by the way. This is, Salter is a 250-year-old brand. It comes with a 10-year guarantee. It's a forged pan versus a pressed pan. Oh boy, why that's a good thing. And it's got a Megastone coating, which we have exclusivity on in the UK. What does that mean? It means you need to use less oil, which fits in with the kind of health sort of narrative that we hear a lot about at the moment. And you can use a metal utensil. And on top of that, it comes with a 10-year guarantee. And this retailed recently as part of a promotion in Tesco's for £15. So it's all about hitting those mass market prices that the squeezed middle can afford. But it's about giving them a product that's great value and one that they can be proud of having in their kitchen. That's who we are. To quote Simon, who is our chief executive and founder, and Simon founded the business from a room about this size about 20 years ago. It's about Asda products. It's about John Lewis products for the Asda price. If that makes sense. So that's who we are. In terms of our strategy, it's quite simple. If you think about what I've just said then about kind of branded products, targeted at the mass market. Where we look to focus is on these four main channels. So first of all, discounts, which I think is fairly intuitive, because the price points we're at, but also because of the branding. Own label is often not a choice available to discounters. So what we offer, which is a branded product at a discount price, is quite appealing to that channel. Number two, UK supermarkets. We were historically very underrepresented here, and going into the IPO, that was certainly still the case. But at the end of the day, and UK supermarkets have had a fairly tough time. I'm talking about Big Four here, over the last sort of 10 years or so. But it's still where most people go each week for their groceries. So we have as one of our strategic priorities to target the Big Four and persuade them. And often what it's about is persuading them to give us some of their own label space. That's who our main competition is out there. It's our retailers' own kind of sourcing and own label offer. Number three, online. We started to become more branded about 5 years ago. We'd accumulated some really nice brands that we bought out of distress, so brands like Beldray, we bought Progress out of administration, Tempo, and we noticed that they performed pretty well in store. So we started to put together core ranges. Before then, we were more of a back-to-back sourcing business. We'd sell, then we'd buy. Becoming more branded meant we carried some core ranges in stock, and that opened up online as a channel for us, because of course if you don't have stock, you can't service the online channel. And online is sort of rapidly growing. Grew 50% last year. It was 8% of revenue. We have a target internally of taking that to 20% of revenue, because if you think about hard goods, which is the space we're in, roughly a quarter of our kinds of product are transacted online. So it's starting from a low base. We believe there's strong growth potential there. And then the fourth one is international. International because we do a load of product developments and a load of work and a load of investments, and then we used to insist on selling the products of that on this small island at the edge of Western Europe. So we thought, international is a strategy as well, leveraging those investment costs in terms of product development across international territories, and we decided to focus initially on Germany, and I'll talk a bit more about that later. So how are we doing? Well, as Hannah alluded to, we had a FY18 year end of 1st of July wasn't very good at all. We like many other people, we suffered from the very, very tough market for non-food in the UK, and we've seen that in retail, particularly we've seen lots of administrations, House of Fraser, Toys R Us, Macklin, Pound World, CVAs like Factory Shop, Carpetright, Homebase, Evans, Mothercare. Been extraordinarily tough for non-food over the last 12 months or so. Why is that? Well, I've been explaining this quite a lot over the last 6 months, so well practiced. The reason is that it is up until quite recently we saw quite strong wage deflation. So the overall basket for retail being smaller, but also within that basket, food taking a larger share, because obviously people prioritise food, and food is taking a larger share because of food inflation. So you look at non-food taking a smaller share of a smaller basket, which is what's led to the kind of distress that we've seen on the high street, particularly with physical stuff. People who sell non-food with a large physical estate. Overriding that, we've had, it feels like a step change in terms of online, which has always been growing rapidly, but it feels like the last 12-18 months there's been a definite change of gear in terms of online penetration. And then finally, retailers were faced with cost inflation. As all that wasn't enough, cost inflation on their non-foods. And what that led to, from our perspective, was retailers having to, understandably try different things. They were faced with a bit of a Hobson's choice of, well, we can increase our retail price points and almost certainly see a rapid drop in volumes, or we can try something else. And often what they tried was things like direct source, own label, maybe going to other suppliers who were of a poorer quality. But more generally as well, supreme cautiousness in terms of their ordering. When you have a change in retail price points, the volumes are quite difficult to predict, so the obvious thing to do is to be cautious. So it has been a tough year for us. Thankfully, at the end of the year, we saw a decent finish and also a better order book going into FY19. How we've responded to that is we've really focused on our strategy, what we've gone through. Then we focus on the fundamentals of the business, which is something which I'll come on to in a few moments. And also, we have a saying in the business: stay safe. Focus on the financial strength of the business, which again I'll cover in a little bit more detail later. So operational highlights. Tough times bring opportunities as well, and one of the things what we often see is the opportunity to acquire brands out of distress. So we bought Belgium out of distress for £200,000 in 2009. It's now sort of 20 to 30 million pound brand a year. We bought Progress for £10,000. That we did £3 million last year, and the growth this year. So we have a kind of track record of kind of opportunistic sort of buying of brands out of distress. And Clean Easy is a good example of that. The brand, it's almost 100 years old, very well recognised. Went into administration earlier in the year, and we paid £100,000 for the brand. We've just we've refreshed the branding, and we have inventory on its way for a launch in spring summer of 19. So every cloud has a silver lining. And Progress as an example is further of this as well. Progress is further ahead than Clean Easy. We relaunched this in 2016, and we are starting to see quite strong demand on this now. We did £3 million in FY18. We will see growth in 19. And what we are seeing with this brand, a bit counterintuitively as a British heritage brand, is that we are seeing it being well received in Europe, and we do expect the majority of demand on this brand to actually come from outside of the UK. Really nice Lancastrian bakeware brands, dates back to the 1930s. The next two slides cover this point about online, but also focusing on the fundamentals of the business. We've continued to invest in this channel, both operationally and in terms of our systems and tools that we use to manage it. We saw 50% growth last year, but we also, within that, we saw an acceleration in the second half, and we are seeing that momentum continuing into FY19. We were 8% of revenue last year. We want to take that to 20% in the medium term. One of the challenges we have with online is we sell through many channels, so Amazon, eBay, Groupon, and also many of our customers, we sell to them on what's called a dropship basis. So we have quite a lot of innate complexity there, and what we're great at, and we have an in-house development team that does this, is we're great at building systems in-house that can deal with that complexity in a cost-effective manner. Germany, wrong one. So, UK got tough, and we do what we've always done, and I'll come back to this at the end of the presentation. I'm an accountant by training, so I don't manage the commercial side. Simon, the CEO and founder, manages the commercial side. And I've been with the business for 13 years, and I think what still amazes me is their ability to innovate and create. So UK gets tough, so what does Simon do? He opens a showroom in Cologne, and we go great guns at the German market, which is the biggest consumer market in Europe, bigger of course than the UK. And what we saw when we went to Germany was, Germany is very well established in terms of discounts, but it's quite cheap and nasty, in my opinion. What we offer is distinct, but it's still mass market, it still appeals to the discount segments. So we are seeing really good traction with the German market. We've opened a number of large multiples over there, and we are starting to see repeat orders coming through from those accounts. So very pleased with that. Oh, that's this one here, sorry.
That move it the wrong way.
Yeah. So, I said before about we kept focusing on the fundamentals. Our people, we're very much a talent business. We are, Oldham is by allegedly the most deprived town in England. And we are a leading employer there that has a graduate development scheme. And something like 90% of our non-warehouse positions go to new graduates. So we've kept investing in our people despite the challenging trading. And what's really brilliant about it is we launched this in 2012. Some of our key functions now are actually being headed up by people who started on the graduate scheme. So our head of IT, our head of housewares, head of QA, and head of online all came from the scheme. It's a really almost a unique offer in Oldham where we're based. We're now expanding this out. We have something called the Grad Plus scheme, which is aimed at people who maybe have left university and worked in a bar for 12 months, or have made have decided they want to really focus on their career. And we've also opened something called the UP Academy together with Oldham College, which is focused upon people who don't want to go to university but do want a career. So we're working closely with them. It is it's brilliant to see. In terms of the numbers, as I say, we've what you'll see on the next two slides, and I think probably page 14 is the better one, is it's very simple. A lower revenue converts into lower profitability. Margin was stable, largely because we were able, despite some cost headwinds we had, particularly around currency, we were able to change the mix of the business and hold that margin stable, and overheads remained broadly level year on year. So it's a simple story of lower turnover converting into lower profitability. On the segmental slides, again, the decline in revenue was fairly broad-based. But there was just a few things I wanted to point out to you. First one is the growth in Germany, albeit from a low base, and we expect to see, we will be seeing growth in FY19 there, and I'm sure in future years. But also international. The business has always been predominantly UK, sort of 3/4 UK. Second half of FY18. 37% international, and that kind of, we're seeing that momentum continue into FY19. So we're becoming less dependent on the UK, although at the moment still majority UK. I think the question we're asking ourselves internally is, at what point will we become less than 50% UK? And I think it's this side of the horizon, I feel. Online again, up 50% in the year, but with an acceleration in the second half, with that momentum continuing into FY19. And finally, the growth of Progress, a brand that we only paid £10,000 for, giving us 3 million of revenue in FY18, and to say growth in the order book for FY19. I wanted to spend a few moments on the balance sheet, because when we did our investor roadshow a few weeks ago, there was some concern about our level of debt, because the debt's gone from 6 million at the end of FY17 to 12.9 million at the end of FY18. This doesn't concern us, and I'll try to explain why. We have a very simple balance sheet, a bit of fixed assets, and then the rest is working capital and debt to fund that working capital. And what you saw at the end of FY18 was a growth in debtors and a growth in stock. And I'll take those in turn. Debtors grew because our invoicing in June and July was stronger than the year before. So I think that's a good reason. And stock was higher for a couple of reasons, but mainly because our order book going into FY19 was stronger than the year before as well. So although stock went up by nearly 50%, our free stock within that, i.e. the stock that we have available to sell, actually went down. So we saw a significant increase in stock, with stock held to service orders in the first quarter. So again, two good reasons for why our working capital increased. Now, what we then have is specific funding lines to fund our working capital. So we have invoice discounting for our debtors, and just to put it into context, we have debtors of 15.8 million funded by invoice discounting of 4.5, so very conservative. And we have a stock balance of 16.5 million funded by a stock finance line of 6.6. So again, sort of, very conservative level of funding. Our headroom within our facilities was over £9 million at the end of FY18, and our bank covenants, we are operating very comfortably within those bank covenants. And just to highlight as well, although we had a tough time on earnings compared to expectations, we were profitable. We only distributed half of our profit after tax, which has meant our balance sheet, our net assets have kind of been sort of, nicely increasing over the period since the IPO. So we're very happy with our balance sheet, and as Hannah mentioned, we do have a 2 times cover on our dividend as well. You can see that on the cash flow statements here, this movement in working capital, as a result of the stock and debtors increasing at year end, or towards the year end, is why we saw that outflow across the year. So where's it all heading towards? Well, we reported a couple of weeks back, and we are trading in line with expectations. What we've seen really is, I mentioned before about how customers had to try new things. We're seeing those customers coming back to us because, it's a really kind of obvious thing to say, but our product sells. It really does. We have what's called a land and expand strategy with own label. We'll say to a customer, look, your own label's good, but why don't you try our salted product, say? And once it proves itself, then we expand the listings and we expand the distribution across stores. And what we've seen is customers go away, try other suppliers, maybe not get the service, maybe not get the quality, maybe do some direct source, but direct source is quite hard because you need the overhead. It doesn't do itself. And of course, retailers are typically trying to reduce their overheads. So we've seen a number of customers who kind of went away from us come back to us. We're seeing strong growth in international and strong growth in online. As a result of that, our FY19 order book is ahead of this time last year, which we're pleased about, given that the market continues to be incredibly tough in all periods. Balance sheets continue to be strong with comfortable levels of headroom, and that's going to be important if we are going to continue to pick up opportunities along the way. Maybe another clean easy, hopefully in due course. So yeah, I think finally what I would say about the business is, because there's been lots of talk about our dividend and the cover and the strength of the balance sheet and all this kind of stuff, but the amazing thing I think about the business, I look at this a little bit as an outsider because the commercial team doesn't come directly under my remit, is its ability to adapt is in whatever environment, it always amazes me. And I think if ultimately you're looking at us as a say, as an income play, and you want to understand how secure that dividend is, and there's no guarantees what the future, of course, is that, you know. Our ability over the years to respond quickly to the challenges of the market, I think does set us aside from a lot of other businesses. So adaptable and resilient, that's what the way I would describe us. That's all I have. Any
very positive notes. Everyone, any questions?
Any questions? Christmas is very important to us. But we're not as we're more evenly spread than perhaps other kind of consumer businesses. So if you split our business into two halves, so August to January, normally about 55% of our revenue occurs in that period, and normally 45% in the second half. I mean, it can fluctuate, but that would be a normal run rate. But you know, we do have kind of counter seasonal products. I mean, cookware, for example, sells well over Christmas, but it also sells well across the year. Audio tends to be very Christmas focused. Luggage, which is a division we have, tends to be more spring, summer. So yeah, it's a very important season for us, and if we have a bad one, it's a difficult one to recover from, but it is a bit more spread. In terms of our invoicing, customers take our products in different ways. So some will take product FOB, so they will effectively take the goods as they're shipped from the Far East. Some will want it delivered into the distribution centre, and some of our online customers will want it ordered today and delivered today. So what you have is, say, in August you'll have the first lot of Christmas FOB shipments, and then we'll still be sending stuff out for Christmas on Christmas Eve. So we don't have a kind of a really spiky invoicing profile, but the season is very important to us. And Brexit was the second one, wasn't it? Right, Brexit is a headache we could all do without, in my opinion. And for us, the exposure with Brexit is not really so much about trade. Nearly all of our product comes in from the Far East, so it's already subject to WTO tariffs. We're not expecting too much disruption at the ports, because our product tends to come in. Our product comes in through Southampton, which does nearly all of its trade outside of Europe. So we're not kind of, if there's a disaster at Dover, we should be okay. For us, it's about currency, and if we see it, currency for us is something we can always adapt to given time. So in the time I've been with the business, we've had a dollar rate of 208, and we've had a dollar rate of 124. We've made money all the way through. Where it gets more challenging, we have sudden movements. Now we do hedge, and we have a quite sophisticated hedging policy, but that will only buy you, realistically, sort of 12 months, and it's better to get more than that. So that's where our greater exposure is. If there's a structural change in the dollar rate as a result of a hard, a kind of cliff edge Brexit, then that would provide a challenge to us, like it did in 2016. But we'll just have to go again, won't we? Like all the business, we'll just have to deal with it, like we've dealt with it recently, and that's what we do. Yeah. Well, what we're finding is the gross margin is higher for us, because we're combining a wholesale and a retail margin. Okay. But of course, with online, you have more below the line costs. So it's more warehouse intensive, and more labour intensive in other ways. What we're finding when we're analysing it is we're broadly hitting a similar net margin to the rest of our wholesale business. And you know, we have 5 guiding principles that we run the business by, and one of them, is cash, cost, and caution. You know, we've taken an approach of selling via other people's platforms, which is a bit unsexy. You know, it's best to have your own website with lots of traffic and stuff, isn't it? You know? But we want to make money every year, and we don't want to swap what is a variable cost, which might be what we pay Amazon or we pay Groupon or whatever, for a fixed cost. It might be, you know, it might be a bit unsexy, but that's the way we are. We're quite conservative in the way we run our business.
Thank you.
Yeah, I mean, we do have a small amount of sale or return. So, for example, Argos is a sale or return account for everyone, but not much. But the reality is, if we sell a product into a customer and it doesn't work for them, then we want to be part of the solution. So you kind of have the legal side, which is, yeah, it's all committed sale. But then there's the commercial side, which is, if there's a problem, you know, part of the service that we offer people is to be there to help sort that out. Thankfully, we don't have many issues, and our returns rates, for example, are very low as a business. But yeah, it's forward order. This is changing a little bit. A couple of years ago, our forward order business was probably 80%. It's probably nearer to 60 now. We have a larger sort of stock side of the business, of which online is part. So. Well, I think in terms of breakout, we have our 4 pillars, and that's where we do see growth coming from. And we are seeing growth, although for FY19. We are seeing growth across the 4 pillars, albeit international is probably the more notable development. I think if we're looking at a step, it probably is international. But I don't think that's the way we behave as a business anyway. Okay. I think we are more conservative in our approach. Simon is a charismatic guy, and he might give you that impression. We're quite conservative as to the way we go about things. Sure, the opening of the German showroom is a big step, but we're paying less than £200,000 a year rent, and to service that office, we have 5 people based there, 250 grand fit out. If it ends up being a disaster, which it won't, if it did, you know, we never overreach ourselves as a business. And for that reason, we've made money every single year since the business was founded. No, you know, our bad debts in the last, say, 10 years have sort of been no more than sort of 30, 40 grand a year. So our default policy is we only sell insured, and to the extent that we make exceptions to that, it's with the full sign-off of the non-execs. It's not something that the executive team can do on their own. So we have to make a case. You know, I mean, it's always just because it's not happened in the past doesn't mean it won't happen in the future. But again, returning to that point, we do run the business conservatively, and to the extent that we do take an uninsured risk, it tends to be pretty modest. And if you think about our customers, you know, people like the big 4 supermarkets and et cetera, it's a decent list.
Lovely. Well, thank you very much, Andy.